So let's talk to our panel now and talk about the current credit environment. Is it really a tougher credit environment out there, or is that easing? Laura from Wells Fargo, do you want to kick us off here?
Sure. Thanks, Mary Jo. Well, at Wells Fargo SBA Lending, we never stopped lending with the recession, which is probably one of the reasons we're the largest SBA volume lender. But some of that lending stability comes from a position where Wells Fargo portfolios all their loans, so we never relied on the secondary credit market. However, with the recession, we did witness, in our portfolio that the restaurants had taken quite a hit. I mean, the impact of the recession certainly hit them probably the hardest. Even with our seasoned operators, they were struggling as well.
We're having a little trouble hearing Laura.
Oh, I'll try to speak up. Is that any better?
There we go. Thank you, Laura.
Oh, so sorry. But I was just saying that with, since Wells Fargo portfolios, we've noticed that, the restaurant segment has been hit pretty hard with this recession. And, with that, it's easier on restaurant loans than it is to do a restaurant loan. We've changed our criteria, 3 years ago and made it a little bit tougher. We want, the most seasoned operators. And so we require 5 years of restaurant management experience as well as a 50% equity injection for a startup. So we're still doing restaurant loans, but I'd say the majority of what we are doing now is non-restaurant.
Okay. And Keith from SunTrust, where are you at with this? Is it easing? Do you see it easing?
I think in some instances, depending on the industry, things are more leveling off. Maybe not easing, but leveling it off. But one of the big questions I've been getting for the last year and a half is what are happening with the smaller loans? And those loans between 50, 100, 150,000. I think the big thing there is it's a matter of time versus reward for lenders. If a $75,000 SBA loan may require, in many instances, it requires the same amount of paperwork as a $300,000 or $400,000 loan. So the lenders are really looking at that, and also what they're looking at is what kind of business will that bring to our bank as opposed to just a transaction. They're looking for more relationships for those smaller deals. So that's where, and we'll get into this in another segment, but that's where the area developers or the masters can help by getting more in tune with their community lenders and credit unions in their area and selling their franchise. But I get a lot of those questions with regard to the smaller loans, and those are tougher to get.
But I know it's been incredibly difficult for them to get loans. Do you see it as harder for restaurant franchises?
Absolutely. And the biggest difference is several years ago, somebody would say, hey, I have a 2-week training program or a 3 or 4-week training program. And that used to be enough for a lender to say, okay, we've got training, we don't care about experience. So the franchisors don't mind not having experiences because people don't bring any bad habits or preconceived notions. But the way the lender's portfolios and their experience with restaurants, we'd almost rather see somebody come in with restaurant experience to have some knowledge of the industry. That's what I'm really seeing, and experience is very much come into play over the last year and a half as opposed to several years ago.
This is Scott Haner from KFC, and I think one of the things that we found is that a lot of the lenders already had a lot of exposure in the restaurant business, and so they certainly are not getting out of the restaurant business. They already have plenty of exposure, but as far as new loans, they've been much more or much less willing to play. Either the community banks that didn't have as much exposure, franchising space in and of itself, because they just haven't done a lot of that lending, and all of that just tends to string out the time that it takes to get financing. And that's what I hear from our people.
Scott, from Sports Clips, you're not a restaurant, but you're a service business. What do you see out there for your franchisees?
Well, I would echo. Thank you very much for having me on the call. I would echo some of the comments that Keith has made. I think we're seeing it, I don't know if we're leveling off is the words I would use, but is it easing? I don't necessarily think so, but I think it's more that we're in the new normal today. And I think the new normal is lenders have a smaller credit box or have focused on certain industries or defocused, as mentioned previously, on industries that they had focused on before. And I think the challenge there is, especially as you're looking at potential new sources of financing, is that everybody's doing their due diligence, not just the lendor, but the franchisor in who they're working with and making sure that there's a good fit there before you get down the road too far.
And Mike from BoeFly, what is your perspective on it as far as service business, restaurant business? Who's getting funded?
Yeah, one of the things that we do, Mary Jo, as you know, we work with franchisors matching their franchisees up with more than 500 banks. We've got a nice perspective into what's happening, and what we are seeing is the community banks, that if you can consistently get in front of the right banks who are interested in those type of loans, whether they be restaurants or service or startups, is the important piece. We had a nice example of a Subway financing that took place, and the owner was in Cleveland. None of the local banks were interested, neither the national players. What we found was 1,500 miles away was a small bank with a national charter that actually stepped up and did that Subway financing. So, it's important for franchisors to think about how can you get your franchisees in front of those community banks in a consistent way and share data in a good way, to Scott's point.
That's really interesting.
Mary Jo, Darrell, FRANdata. I think one way of characterizing the situation today for lending is simply that we're off the bottom from where we were a couple of years ago, where it was access to credit is the big issue. But now we're in a multi-year period where it is a competition for credit. And that has changed the nature of how lenders are looking at franchising in ways that have just been described by several different people. Essentially what it comes down to is that not only is the borrower credit box changing and tightening to a large extent, but we are now dealing with the issue of whether the franchise system itself is creditworthy. And that is starting to change the dynamic. Out of this, we see a gradual evolution into a new type of creative lending programs. See franchisors that are now starting to look at either internal programs or shared programs in some fashion. We see organizations like BoeFly that are out there to try and find a more efficient way of connecting those community banks that don't have a very wide radar screen to find deals.